Welcome to the part 2 of Workplace Savings Schemes Introduction to Good Governance. I'm Tim McGuinness. If you've watched part 1, you will have seen a brief introduction from me there, but I've been involved in governance now for 20 years and involved with restricted schemes, and in the old case, superannuation schemes for over 15 years. So I've been around a bit. I'm once again being joined by Brian Connor in this presentation. Brian can briefly introduce himself now, hopefully. Leave it to you, Brian.
Thank you, Tim, and hello, everybody. Yes, Brian Connor's my name, and I've been involved in the trustee industry for my entire career, more latterly in the corporate trustee services side of the business, and in the last 5 or 6 years as a licensed independent trustee. Back to you, Tim.
Right, so outlining what we're hoping to get to today. Hopefully you've had a look at part 1 of our Introduction to Good Governance for Restricted Workplace Savings Schemes that Brian and I put together, where we looked at the governance from the perspective of individual trustee directors. What you should be thinking about for your individual behaviour and what you should ideally bring to the board table. What we're looking to do today is, in this part 2, is explore more of the behaviour and expectations for the collective group of trustees, what you do as a group around the table and how that works best in practice, rather than just the individual. How you should work together to gain a collective view, and touch on some of the key areas and questions for trustee directors when they're collectively considering their trustee role and their governance role. Now, I'm conscious that we'll cover quite a bit of ground in a very short space of time today, but please do bear with us on this, because the foundations of good governance are so critical in achieving good outcomes for members, as we discussed in part 1. So governance is important. There's a lot of detail. This is an introduction, but hopefully it gives you some things that you can take away and think about and work on and follow up on. So moving on, first of all, a bit of context. Let's look first at a bit of history. Now, in New Zealand, 3 key elements have shaped the recent thinking on good governance and what it should look like for restricted schemes. The first was the introduction in New Zealand of the Financial Markets Conduct Act and regulations in 2013, 2014, about then. Now, those regulations and acts completely reshaped New Zealand law in the area of financial services for all managed investment schemes and the like, but for restricted schemes as much as. It had a very material impact on the governance and the management of workplace savings schemes and all managed investment schemes. Around the same time, a little bit thereafter, there was the Australian Royal Commission investigation into conduct and culture in the Australian banking, insurance and superannuation area. And this was followed in New Zealand by reviews done also by the New Zealand Reserve Bank and the FMA into financial institution conduct and culture, starting with the banks, dealing at the moment with insurance, but linking into other investment opportunities, investment structures. As a consequence of those 2 things, there's been a real general expansion of the New Zealand FMA role in this regulatory oversight, and in particular their role in providing greater clarity to the market and the likes of restricted scheme trustee boards over what's expected in the terms of conduct and culture and behaviour of financial market participants. Over the last 6 years, the New Zealand regulatory framework has really upped the ante, if you like, on trustee directors or directors and managers of schemes to ensure they do have robust governance processes and have really robust conduct and culture frameworks. So what we're going to do today is look first very briefly at a recap of some of that FMCA development as it applies to restricted schemes, and then move on to conduct and culture. So first of all, recapping a little bit on the FMCA. As I mentioned, it completely set a new framework for managed investment schemes and investments in providers such as restricted schemes in New Zealand. For ourselves in restricted schemes, we got a lot of carve-outs from the standard models applying to most schemes because we had somewhat unique characteristics. And I'll cover on some of those very briefly as setting the scene. For ourselves, it combined the roles of trustee, manager, and custodian, generally and often into one entity, which is the trustee company or trustee group. It compares to most other managed investment schemes in New Zealand where those three parties are actually usually separately managed and controlled entities. You have the trustee or manager, you have the custodian, and you have the supervisor. In our perspective, you don't have that, so we don't have a particular separate supervisor, for example. So the FMA has primary oversight over the restricted scheme sector. As a consequence of that, also, as we mentioned in part one, schemes are required on their boards to have a licensed independent trustee, and we've covered that off in part one in some detail. The Acts and regulations also introduced for most restricted schemes a continuous disclosure regime, which effectively is about if something material changes in your scheme and you're offering to members, you make some decisions or some key changes, then you've immediately got to make some changes to your key disclosure documentation. And that all forms part of now a public register of documents, which is held on what's called a disclosure register. Now that compares with the old days where some schemes might have had prospectuses, but majority didn't. And disclosure and maintenance of disclosure requirements was nowhere near as onerous. The FMCA has, a part of that, also produced a much wider suite of prescribed documentation that boards and managers have to produce and maintain: product disclosure statement, other material information statements. You're now required, mandated to have a SIPO, produce annual fund updates, an annual report within certain timeframes. We have quarterly reporting frameworks for the FMA. So quite a much wider suite of prescribed requirements that fall onto the boards of restricted schemes as much as anybody else to make sure they have good processes around meeting their obligations. So that certainly has increased compliance, and the impact has changed the amount of compliance everyone has to do. But the whole issue around the FMA's reviews and the Reserve Bank reviews and the Australian Royal Commission's reviews, that it's all much more about conduct and culture than it is about compliance. Conduct and culture, compliance is a good outcome of good conduct and culture. Now, the Australian Royal Commission and those New Zealand reviews had a lot to say about poor governance, oversight, and weaknesses in their systems and controls at financial institutions. And so that's why the emphasis is on that conduct is what matters. And it's more than just box ticking. It has to be the way you make decisions at all times, rather than just something you come back to and say, I've done this, I've ticked a box. So when we talk about governance, we're talking really about conduct, how you behave, how the group behaves, and how you make decisions and think about your business, of which part of it is good compliance. The other aspect of it that's worth mentioning very quickly is that it's important that you're able to demonstrate you're doing things. It's no good these days just to be able to say, oh yeah, we talked about that, or we did talk about that sometime. It's important that you do it and you're seen to be able to do it, and you can demonstrate you are doing it. And so when, for example, a regulator might come and talk to you, he might ask the question, show me what you do. And so you need to be able to do that. That's a brief introduction, but if you're coming in, so what we're going to focus on really is what we regard as good conduct, and a lot of what governance frameworks flow from that. At a very high level, there are 6 sort of norms of good conduct that we probably want to draw out. Now, none of these are particularly contentious for restricted schemes. They're the sort of things you would expect every good trustee to be focusing on. Particularly if you have a fiduciary role, you have a trustee which sets out specific obligations and requirements. So there shouldn't be any surprises to anybody in these, but I'm just recapping on them. The first one is to obey the law, which includes ensuring the provisions of your trustee are adhered to. You shouldn't mislead. You need to act fairly and equitably across your membership base, provide services that are fit for purpose, deliver services with reasonable care and skill. So once you've decided what you want to provide, actually do a good job of delivering it. And importantly, when acting for another, act in the best interests of that other. Now, for restricted schemes, that's been our bread and butter forever, really. When you have a trust deed and a focus on members, that should be what you're leading to. The recent developments of the FMCA and the Reserve Bank's view on conduct and culture has widened this out across financial services more generally. So some of what's been talked about now is some of the things that the schemes have done for a long time or done forever. What's required now is to be clear about the robustness of your processes underlying it. So the question is, how do you best put this in practice then? Those are the norms. How do you do it? How do you best do it? Now, there's a large body of potential guidance material you can call on. There's the FMA in New Zealand has a lot of guidance material. The New Zealand Institute of Directors has a lot of material on what it regards as good governance. The UK pensions regulator has guidance, and it's just going through a whole review at the moment, I understand. The Australian regulators and the Royal Commission put out a lot of findings. So there's a lot of stuff around. What we're going to do today, though, is just for this presentation, base our comments and our guidance and our comments on an FMA guidance paper put out in 2017, where they express their expectations for conduct under 5 key principles, 5 key headings, conveniently called the 5 Cs: capability, conflict, control, and culture and communication. Now we're going to go through each of these in turn, and how will we do this? First of all, we're going to ask for each of them, what's the member most interested in when you're talking about conflict or culture or capability? And given that's what the member interest is, what are the sort of questions that trustees or collective group should ask themselves from time to time about what they do in meeting their expectations or the expectations of their members or the regulator? And if you've asked those questions, if you're sitting around a board table today of a restricted scheme with what might be regarded as good conduct practices, what are some of the things you might expect to see in terms of the processes and decisions and conversations that boards have on those headings? So just to be a bit like a checklist. So one thing you may take from this at the end, I hope, is that once you've been through these, you'll have a bit of a checklist of the questions that you should ask as a director and some of the things a board might see from time to time in its framework of processes and compliance, that it helps to address those 5 or address those areas. With that introduction, I'm now going to pass over to Brian to talk about capability, conflict, and control. And I'll pick up back on soon on the last 2 and wrap up at the end. So Brian, I'm going to pass over to you now, and they'll just take us through those areas.
Thanks, Tim. So as we work our way through the 5 Cs, we will of course be focusing on what is actually relevant to workplace savings schemes. But it is important to be very familiar with that FMA's guidance note, because this is the FMA's view on what good conduct should look like, and this is how they're going to look at it when it comes to addressing issues. So it is important, though, just to think through that this guidance note was drafted not only for workplace savings schemes, but for all managed investment schemes. So this includes KiwiSaver schemes, and we're talking about billion-dollar KiwiSaver schemes, as well as very large retail unit trusts. But notwithstanding this, the overriding message is exactly the same. It is, what is important here is good standard of conduct when dealing with our members. So with that in context, the very first factor that I'm going to look at, as Tim mentioned, is capability. So this is what our members care about. But do the persons that are appointed to manage the affairs of the scheme have the knowledge, the experience, the skills, and the capability and the professionalism to actually provide the services and to look after my interests as a member? And the structure itself, does it meet the needs of myself as a member? And does it enable trustees to meet their regulatory obligations in a cost-effective manner? So look, first, before we get into some real detail, let's look at the trustees sitting around the table. And the questions that you should be asking are whether the mix of experience and skills sitting around the table are the right experience and the right skill set for the scheme. And how do we go about continually improving the skills of trustees? And should the collective trustee performance be reviewed from time to time? So if we look at our next slide, we will see that a very useful tool as a starting point is what I call a skills matrix. So this would consist of a list of the relevant skills and experience needed to manage the affairs of the scheme. And unfortunately, there is very little guidance here in New Zealand as to what this could look like. But in Australia, APRA have put out a paper headed Superannuation, How a Skills Matrix Can Help Transform Board Capabilities. And this, I think, is a very useful starting point. So by completing a skills matrix, I think a board will be able to better understand what skills are in short supply or missing, or indeed whether there are particular skills that may not be necessary. They can, for example, be brought in, like legal advice, for example. Do you need to have somebody with legal experience sitting around the table? Or when you need legal advice, can you go and buy that in? Those are the sort of questions that you are able to answer with a skills matrix. Now, admit for smaller schemes, particularly closed pensioner type schemes, we're a little bit more limited here in terms of what you can get from your trustees or for the skills of your trustees. Usually in these cases, the power of appointment rests with the sponsor. And while trustees can make known what sort of skills they want to sit around the table, they don't always get what they want, particularly where the trustee provides for pensioner trustees. And there is a very limited supply of pensioners available to provide those services. But anyway, I still think a skills matrix is a very good starting point, and it's very helpful because it does give you a good picture of what skills you have and what skills you're actually missing. And indeed, if there are some skills that are missing, then these can be improved by a targeted training program. Just putting that aside though, training I think is actually a key focus for all schemes, no matter how big or small they are. And it can also be a useful way of updating you, a reminder of what the legislative obligations are. It can be a continual review of how good conduct should work. It can also help you understand the investment markets and how they work. And also, of course, the general duties and responsibilities of directors and trustees. And it doesn't hurt to be reminded about these issues on a regular basis. I think it's good just to at least have one training session a year, either as part of a meeting, or my preference actually is to have a separate day or a separate afternoon, if you like, focusing entirely on training, because that way there are no distractions. One of the more difficult issues to deal with is actually trustee performance. So how do you determine whether trustees are actually adding value? And again, I think the larger the scheme, the more important this issue is. And again, the smaller the scheme, the more difficult this becomes in terms of actually how you manage this. I think an annual review should be undertaken no matter what the situation. And I acknowledge that this is not going to be so easy for smaller schemes. But some of the questions that you can actually ask yourselves as trustees could be, were we well prepared for the meeting? Have we considered each matter with an active inquiring mind? And I think that's the key words there, is active inquiring mind. It is very important to face all issues and actually have an open mind about issues, but remember, we're acting in the best interest of our members. Now, did we participate fully in the discussion? Did we focus appropriately on strategy and policy? Do we feel comfortable asking questions or raising issues? Did we question service providers appropriately, etc.? So all those sorts of questions are appropriate when reviewing our actual performance. On the next slide, we have another issue I just want to address. And this actually here is scheme arrangements and structures. And this is talking about what is the best mix here. And this could be between in-house management. A lot of schemes still do have some in-house management, and is that still appropriate going forward? or is outsourcing a better way of looking at things, a better way of managing your obligations? I do think it's fair to say that the smaller the scheme, it's more likely that a complete outsourced model is appropriate. But the larger schemes may have more appropriate needs. But nevertheless, it's important to sit down and actually look at your requirements to make sure that you can deliver good outcomes for members. Now, in terms of the actual structure itself, there is actually no right answer here. Some boards are corporatized, and I think the larger schemes, that is probably the case, while a lot of the smaller schemes still have a board of trustees. But as I said, there's no right answer. They both can work as long as they can deliver the right outcomes for our members. So trustees should be confident that their structure and how they manage their scheme meets our members' expectations, no matter what the structure, and enables our trustees to act in members' best interests. So in the next slide, we look at the bigger picture here. It is good practice to have a periodic review of the scheme inputs and outputs. And I say periodic review because I think the larger the scheme, probably more regular you'd want to undertake these reviews. The smaller schemes, probably a review every 3 years would work. We'd also recommend these sessions are held independently to a scheme meeting, as trustees need to approach these sessions with a clear, open mind and do not want to be distracted by meeting issues. What is needed is thinking outside the square or outside the box. Are there more cost-effective alternatives? What are the risks to the scheme of choosing one alternative against another? Are our service providers delivering cost-effective solutions? Does the scheme continue to meet our members' needs? I mean, that's an important question, particularly for some of our smaller schemes. But is there any other alternative? A lot of schemes rely on being able to be wound up with annuity structures, but unfortunately in the New Zealand market, we just don't have adequate annuity structures in place. So some schemes, unfortunately, are caught up with being around until the last pensioner passes away. But nevertheless, it's important to look at these and take appropriate legal advice to determine whether there is another better outcome for our members. So we mentioned in our first governance module that we looked at in part 1, how it was good practice to establish a risk register and keep this continually under review. I just want to focus on this just a little bit more. The larger the scheme, the more often it's important to look at this. And I'd suggest that this should be a regular agenda item. It doesn't matter what size the scheme is, a risk register is a very useful tool to identify the scheme risks that trustees need to continually manage. For example, services being provided in-house may not get the priority that trustees need. And it may well be that this is a risk to giving our members good service. So maybe trustees need to think about this and determine whether or not for our members' best interest, it's better to have an outsourcing model. These are just some of the sort of things that could come through this. The other issue, of course, is our regulatory obligations. It is a key risk if we are not providing or meeting our obligations on time. So again, what is the processes that we have around our regulatory obligations, and can we do that better to make sure that there are no risks of missing our regulatory obligations? So just focusing on an outsourced model, it is now seeming to be the norm. But there does need to be a clear understanding what the service providers will do. And so I guess the question is, are there appropriate service contracts in place, and do they spell out very clearly what the deliverables are going to be? For example, if a member makes an inquiry or potentially a complaint, which I want to come back to shortly, what is the timeline that you would expect that our service provider will respond back to that member? I think it is good practice to review these contracts on a regular basis, because circumstances change, and it may well be that the timelines that are in the initial agreement with your service provider, it may not be appropriate to use those timelines in the future. You may need sharper timelines. So again, it is very important that we review these documents on a regular basis. Again, the larger the scheme, the more regularly you want to review those documents. The smaller the scheme, you probably find they're more they're more appropriate for perhaps a 3-year review or something along those lines. So now looking at our next slide, I'm going to look at conflict. So conflict is about appropriate dealings with related party issues and other conflicts of interest and duty. Well, transparency is definitely the key here. Trustees need to disclose and explain any arrangements with a related party if it is connected to members' interests. So some examples of what a conflict of interest could look like is if you're a party or may derive a material financial benefit. You could be, for example, a pensioner trustee or an employee trustee and have an interest in the scheme, so therefore have an interest in the outcomes. You could have a material financial interest in another party. For example, you could be a senior manager of the sponsor and therefore have an interest in terms of what the sponsor's obligations are, particularly the sponsor's financial obligations. So you just got to bear all these sorts of issues in mind. And there's also this catch-all phrase of any otherwise directly or indirectly materially interest. And again, that comes back to whether you're a senior employee of the sponsor or if you're not caught anywhere else. So the definition of what is a conflict of interest is extremely wide. But turning to our next slide, how you deal with the conflicts of interest is by way of a document or what we call an interest register. So this will set out each trustee's relevant interest in any particular third party, where there is the potential for a conflict of interest. And the type of issues we've already addressed. If you're a senior member of the employer, that is also recorded. If you're a pensioner member, that is recorded, and the like. The question that is often asked is, do I need to disclose personal directorships, for example, that are perhaps in a totally unrelated industry? Well, I guess there are different views about this, but my view is that it is best practice to disclose all outside interests or any potential interest that you're involved in. That way, I think there's just no risk that something is left out. So once you've got your interest register, the next step, I think, is to have a documented policy on the processes to be followed when a conflict is identified. And the common approach to this is for the trustee that's conflicted to note his interest in the transaction or the matter that's being discussed. And then that trustee should be abstaining from any further discussion in relation to that matter, and of course should never vote on that issue. I think it's also very good practice to note in the minutes of the meeting that that particular trustee has abstained due to their conflicts. It is also good to actually note what that conflict is, just so that there's a full picture in the minutes. So where possible, and this is very, very difficult, but where possible, a trustee that is conflicted, and it's well known through the interest register that the trustee is conflicted, then they should not be copied in on any information relevant to the particular issue. But I mean, that's hard, and particularly where the item that's being discussed is in a package of documents for the meeting. It's not easy sometimes to actually extract the relevant papers out from that for that particular individual. So look, you deal with that the best way you possibly can. I think now we turn to the next slide, and I want to look quickly at related parties. A similar type of discussion here, in the sense that there is a clear definition in this case in the Financial Markets Conduct Act on what is a related party. For schemes that use administration managers or outsource to administration managers, and in some cases, relationships with investment managers are considered to be related parties. And under the FMCA, there is a requirement that any arrangement with an entity deemed to be a related party is notifiable to the FMA in the form of a related party certificate. And the Act is quite clear in terms of what that should look like in the circumstances and when that should be delivered. So look at the next slide. The question to ask here is, do you have in place the appropriate governance framework to ensure that any changes to related party contracts, and that includes fee arrangements, trigger the completion of this related party certificate to the FMA? Now, such certificates, of course, need to be verified or signed off by the trustee board and also jointly by the LIT. And specifically, the statement that they're signing off on, that it is being made in these certificates, is that the contracts are fair and reasonable and the costs are market. And the question that should then be asked, is what process we have in place to test whether the contract and the fees are fair and reasonable? Well, again, it's not an easy question to answer, and you do need to be careful on putting out a request for a proposal, for example, which is one way to determine whether or not you've got a fair and reasonable contract. But you do not want to get yourself into a situation, you're not going to get any helpful responses from the market on that basis. But I think if you talk to your LIT, that could be a particular, or it could be a useful starting point, because generally they provide services to a number of schemes, and they may be able to give some guidance in terms of what is a fair and reasonable contract. There are only 2 or 3 main administration managers in the New Zealand market, and generally I think they're pretty similar in terms of what they provide and the fees, etc. So I think it's a reasonable, safe environment to be in if you are with those administration managers. I think they have some degree of confidence that the contracts would be reasonable. Another way of looking at them too is to take some legal advice, and I think surely your legal advisors will have a reasonable indication also as to what is fair and reasonable in terms of what should be in the contracts. The next slide I want to look at here is a matter of dealing with disputes and complaints. Now, pursuant to the FMCA, schemes are required to engage with an independent dispute resolution service. Generally, most complaints, of course, can be dealt with fairly quickly, and your administration manager, if you've got an outsourced model, are usually able to deal with most issues fairly quickly, and that's generally the smaller issues like missing email addresses or perhaps bank accounts have been changed and have been missed or something to that effect, or even changes of address. So those are the sort of things that are quite common and quite common to see. So just coming back to our next slide, the governance process for looking at this sort of thing, I think the best way of handling this is that it's important to have a complaints register in your agenda for your meetings. Now, the majority of the complaints, as I've mentioned, will be trivial and have been resolved very quickly. But the point here, I think, is that if they're all recorded on the register, then trustees can actually monitor the register on a regular basis and determine whether there is a pattern emerging through the complaints that are happening. And if so, then there is potentially a conduct issue here which might need to be dealt with. So it's just a good guide in terms of what's happening. It also, I think, is good practice to have a dispute resolution policy. And the policy should outline the process that members can follow step by step if they wish to make a complaint. And as we've already mentioned, the very first step, which is where the members make a complaint to the administration manager on behalf of the trustees, is generally resolved at that point. And the policy really doesn't need to go any further. But while it's not common, the policy should cover the next steps. And that is what happens if the administration manager is not able to resolve the complaint in a timely manner. For example, the complaint itself could be about the administration manager. So there needs to be a process in place where the trustees are made fully aware of what that complaint looks like. So that should be your next step of your policy. And then, of course, there's the satisfaction. So then there needs to be a very clear guide about how that member can refer that complaint to your dispute resolution provider. So all those issues should be outlined in your policy. And that policy should be in good, plain English, easy to follow, and be readily available so that if a member requests it, then it can be handed over. So now that leaves conflict, and I want now to move on to control on our next slide. So control is about trustees having an obligation to monitor their delegates and service providers. And we've touched on some of this stuff briefly already, but I'm just going to go to some of this in a bit more detail. So it's important through this process to be able to show how they know what good conduct is, and how trustees need to understand, to show, how good conduct is actually occurring through their delegates and through their service providers. So I'd also point out here, though, that while delegation is definitely permitted, it's common practice, don't forget also that trustees are still directly responsible for the exercise of any powers by the delegate or any service providers. So you do have a vested interest, if you like, in ensuring that your delegates actually are looking after your interests in the best possible way. So to do this, you need to ensure that you seek relevant information to give yourselves a level of comfort that your delegates and your providers are meeting their obligations and supporting good conduct. Now, the next two slides, I'm just going to touch briefly on the next one, if we can move to the next slide. I'm going to move now quickly to the next slide to address these issues. So I want to talk really about the governance level. What do we do at the governance level to handle this? So the first step, of course, is trustee agendas. Trustee agendas need to be structured and items for discussion that will provide trustees with relevant information about good conduct and whether the processes are being managed correctly and so forth should be outlined in the agenda. Some of the things that you should ensure are included, which will help you through this process. Your scheme compliance diary, I think, is a very important document because this will give you the obligations for the scheme for the full financial year. And you need columns in the document to ensure that there are due dates for the relevant compliance obligations. And also you need another column to outline the dates that these items have been completed so that you can see that your obligations are being met. A full year, I think, is a good one, a good document to have in your agenda because it also outlines the obligations coming up for the next quarter, so you can monitor those obligations as you think fit. Another area I think it's very important to have oversight on is payments. There are payments, of course, through our members, which are pension payments in a lot of cases, and of course, if you've got employee members, then of course, payments on termination of employment. The routine monthly payments are generally the pension payments because they don't change from one month to the next, but there are non-routine payments, and these could be purchasing legal advice, for example, audit and so forth. But nevertheless, no matter what the payments are, I think if you're outside your routine pension payments, I think it's very important for trustees to have a very clear oversight as to what those payments look like and have to have an agreed sign-off process to ensure that the payments are appropriate. Perhaps there are some schemes where their administration managers are given a level of that they can make payments up to a certain level, provided they report those payments back to the next trustee meeting. And that's fine, that works. And there are also schemes that would prefer to have all payments that are not routine pension payments, all payments signed off by trustees, generally the delegations given to the chair and potentially one other to manage that process. And that's fine as well, that works. But nevertheless, I think it's important to have in your agenda as part of your meeting papers a list of what those payments have been. It's generally not a very large list. And also what I think is always very useful is to have a scheme budget, and therefore those payments are actually outlined in the budget so you can see how you're tracking against those payments. If that's probably less relevant where your scheme expenses are paid directly by your sponsor, but there are cases where schemes actually have to pay their own expenses, particularly where they've got significant surpluses. Reports from our fund managers and our fund managers, I think, are quite useful as well in the sense that they outline the funds under management, and also generally they're addressed specifically to the relevant party that is the owner of the asset. So that verifies that assets are being held by the appropriate entity, and also verifies or gives trustees the information to verify the assets, which you can then compare back to the reports provided by the administration manager. So all these things are giving you skills, if you like, and giving you documents and tests, if you like, that you can work through to meet your obligations of being in control of the scheme. So the administration agreements with third parties, which I've mentioned, they should be it's very important they're clear and concise and in plain English, and have the service deliverables set out in those documents. So as I've mentioned before, if a member makes an inquiry, that member would expect to receive a response within a certain time frame, and that's got to be an appropriate time frame that meets that member's requirements. So all this needs to be spelled out in the document. You would also expect the administration manager in his report to report back to you at each trustee meeting that they're meeting these standards. And I think some of the things that should be reported from the administration manager in that report should include things like the payment schedules that we've referred to, payments against the scheme budget we've referred to, details of any payments made to members outside of pension payments that I've already referred to, and confirmation that assets are appropriately secured. But as we've already got another way of checking that anyway, but it's still good to have that confirmation. But notwithstanding the information provided by the administration manager, trustees should have in place other measures to monitor what they're being told. And another couple of examples to me is the audit process. And I think it's important to read carefully the auditor's management letter that you get when you come time to sign off financial statements, because that outlines to you as trustees what are the key components that the auditors are focused on during the audit, and also outlines the steps that the auditors have taken during the course of the audit, including interaction with the manager and so forth. So all those issues, I think, are very good checks and balances for trustees to have. And the other thing I think is important is that before you sign off your financial statements, I think it's a good idea to actually have a discussion directly with the auditor about the audit and the auditor's findings without the administration manager being present. Again, these are processes and steps that actually help you exercise good control, and actually it's a framework where it can help you verify that what you are being told is actually happening. So with that, I think I'll hand on to Tim to move on to the next factor.
Thank you, Brian. Right, I've got to first of all deal with culture, and culture is all about leadership and behaviour, and governance is all about good leadership. You know, it's the old saying, it starts at the top and the tone starts from there. It is very true, and for schemes where there aren't large management teams below it, the boards are as effective in management as they are in governance in many respects. It's important that culture is embedded and flows down from there. The key focus for members might be that the manager of the schemes or the trustee of the scheme acts in members' interests, as we've said before, treats scheme members honestly and fairly, and fulfills its duties and obligations. Now, the question for trustees might be, how do you show that your focus is on members of the scheme and their interests? For many of us, as Brian was saying, we might use outsourced providers. So how do we understand or ensure that there's a necessary degree of alignment between the scheme and the trustee and the members' obligations and requirements and the third-party providers' interests in delivering that, so they are all aligned? If you're using in-house providers, say, for example, you might be using HR services. From time to time, you get changeover in personnel. How does the alignment work between the scheme's requirements and the trustees' expectations and the services provided by in-house agents? It's important to be on top of that. And thirdly, under the list of questions I have here, how do we address poor conduct, and how do we know it's been demonstrated? And how do we know poor conduct has happened in the first place? Now, the answer to some of these comes out of some of the things that Brian has already touched on. So they do overlap these issues to a degree. And if you're looking at what you see at governance level to address some of these questions on culture, you come up with the answers such as, the board self-assessment processes and review of performance under capability that Brian talked about, the trustee training and development, regular member communications. We'll talk about communications in a minute. How do you have transparency and good communications with members so they feel informed and they feel they can have alignment with the trustees or the managers of their interests? And the third leg here is the regular third-party provider performance reviews is another example. Brian talked about ensuring you have a process for checking on providers and how they fit, and their fit with the cultural expectations is very important to also check off as part of that process. Do we have an established feedback for feedback for complaints and how to handle them? Is the process easy for members to work with? Do we understand scheme risks? Do we have a culture of continuous improvement? Brian talked about from time to time taking time out just away from the day-to-day board meeting agendas just to talk about how we do things. And do you do that? Do you actually enter into it with the perspective of how can we make this better for everybody? How can we make this better for members? And how do we ensure that service providers also generally follow that mantra? That they have the perspective of members at the end of the chain in mind. So culture is all about thinking about continuously improving, thinking about members and their interests. And part of that, as I said, was also is intrinsically good communication with them. And that's the last C in the FMA's list. If you are truly member focused, then good communication is critical at the end of the day. From a member's point of view, do they feel the scheme and the trustee or the manager is listening actually to them, and they can easily understand the services and whatever the trustee and the products and stuff that's coming back to them? Does the two-way flow actually work? So how do trustees and directors know they're good at knowing members? From time to time, we should ask ourselves about what the appropriate level of communication is between yourselves and your members. And how do you determine, for example, what their level of financial sophistication might be? So how do you tailor communications appropriately? So how do you know members are getting the right information upfront and on an ongoing basis? How do we know that member feedback process is working and our complaints process is working effectively? Do we review it from time to time to ensure that it is? As Brian talked about, one of the key features of a good feedback and complaints process is much to try and pick up the themes underlying the feedback as it is about individual events. If it's a general thrust of a theme, well, that starts giving you some ideas of things to look at. So what might you see at governance level in terms of communications to ensure you've got it reasonably handled? Do you have a clear communication strategy, a plan addressing how you're going to go to members through a whole annual cycle? You obviously have to produce an annual report, but how do you supplement that with other material? How do you do semi-annual reporting? Do you have a quarterly report newsletters? Do you have a website provision? How often do you update it? What do members see? What do they look at most often when they go onto that site? Are there other potential member contact points which are important, given the nature of employers and work environments? Is it for example, I'm in a dairy industry scheme. It has a multitude of sites around the whole country with a fragmented membership base. So how do we deal with member contact there compared to, say, a single member site where it's an industrial site, but all members are on one site and are all closely involved? You've got to identify what actually works best. Thinking about those members, have we considered what financial tools could be appropriate to support members in their consideration of the key decisions they've got to make about the scheme? Member investment choice might be a good example. Got to be careful about giving advice, but there's still a lot of information and support information you can help members with. Do you undertake surveys, either general or specific topic surveys, to try and engage member perspectives and thoughts about how they see the scheme in general or particular provisions, whether it be communications or whatever? Brian talked about member inquiry and complaints handling and the importance of having that robust, but also having good reporting back to the board. So I'm just reiterating that it's important that directors do get a good handle on what that looks like in a general sense, but also being able to deal effectively with individual complaints, because they are individual members that need to be dealt with properly. Another perspective, maybe the one to finish here, is if a member wants to contact somebody, sometimes they just want to talk to somebody who they regard as in charge. Are the trustees and directors actually approachable? Are they willing to be approachable and have that conversation? I think it's very important for most schemes that as directors are recognised for what they do, and actually members are comfortable that they could call them if they really wanted to. Should consider that from time to time. Now that completes our run through of those 5 C's. And I said at the start, we recognise this presentation has really covered a very large amount of ground in a very short space of time. It is meant to be an introduction only, and our ambition over time with the FSC Workplace Savings Committee and its other aspects of these training webinars is to build up a suite of online material which targets more specifically going forward subtopics within these bigger topics. You know, for example, for us, for example, it might be third-party service provider relationships. It might be risk management. It might be how do boards go about self-assessment. We will look for feedback, hopefully, from members and anybody about what topics are of most interest, and we will look to be building that up over time. So hopefully we can build on your understanding and your support or the support for you as we go forward. In the meantime, if you have any general questions on any aspects that Brian and I have raised in this presentation, short as it was, we'd be very happy to take a call. And so our numbers are there if you wish to contact us. Otherwise, I'd encourage you to talk to your licensed independent trustees. They are professional directors on your schemes. While they are, as we said in part 1, while they are licensed to fulfill a particular statutory role, at the end of the day, they are professional directors with good experience in governance. And so by all means, we encourage you to talk to them about issues, concerns, questions about good way of doing stuff or improving stuff. So please take advantage of them as much as anybody else. So thank you. I hope that you found that most useful. Thank you, Brian. Thank you, FSC.